Hey there folks, this is Deeksha Janiani representing Team Trendline. And in this week's video, we will talk about three mid-cap companies which beat consensus estimates of analysts both in terms of revenue and net profit growth in Q1 FY23. These companies are also trading at lower valuations compared to the respective industries. Further, analysts expect these companies to continue clocking decent top line and bottom line growth in FY23. So let's get right in. According to Trendline Screener, which identifies outperformers, there are 9 companies which qualify within the BSE Midcap Index. The companies like Broy Realty, Consign Aerolac Paints, and IDFC First Bank beat analyst expectations on net profit by over 55% in Q1 FY23. Higher revenue recognition in residential segment helped the bottom line growth of Oberoi Realty, while a rebound in industrial segment and a healthy paints demand overall helped the bottom line growth of Consign Aerolac Paints. Folks, within these 9 companies, we are going to discuss 3 companies at length, which are IDFC First Bank, InfoEdge India, and SRF. Chemical player SRF managed to beat analyst expectations on revenue by 9% in Q1 FY23. The company has also outperformed its industry both in terms of revenue growth and net profit growth in Q1 FY23. In fact, SRF happens to be an outperformer in an industry which itself is an outperformer, as it has seen robust growth rates in the past year. Higher demand from global vendors has helped the cause of Indian specialty chemical manufacturers. In fact, Indian Brand Equity Foundation expects the market size of this industry to grow at a CAGR of over 9% to reach 304 billion US dollars by FY25. Circling back to SRF, its top line growth was driven by the chemical segment. Within chemical segment, fluorochemicals business stood out in terms of higher volumes and better realization growth. In fact, within the fluorochemical business, refrigerants and pharma propellants saw better demand and got better prices in the export markets. Also, refrigerants are basically hydrofluorocarbons which find their usage in home air conditioners, auto air conditioners, refrigerators, and chillers. Coming to the packaging film business, the business saw its revenues jump 40% year on year in Q1 FY23, driven by value added products. The technical textile segment also saw double digit revenue growth, but that was lower than the other two segments because of subdued domestic demand. Coming to the EBIT margins, the chemical business saw material improvement in its EBIT margins on an year-on-year basis in the quarter gone by, and that is owing to better prices for the hydrofluorocarbons. In fact, the company expects the segment to report higher EBIT margins in FY23 owing to better pricing environment. The share of chemical segment within SRF's EBIT has grown over 15 percentage points over in the last 5 quarters, owing to healthy top line growth and margin expansion. The in fact the outlook for this segment is also very promising. According to the management, there is a the demand for hydrofluorocarbons is going to be robust over the course of next 2-3 years, driven by the auto and industrial sectors. And that is the reason that company has raised its capex outlay for FY23 by 23% to roughly 3200 crores. Out of this outlay, 2500 crores will be spent just on the chemicals division. However, the outlook for the packaging films business is challenging. The company expects to incur inventory losses in this business owing to sharp fall in the price of raw material in Q2 FY23. Also, the company is seeing many new capacities coming up for the BOPET product, which is a polyester film in the medium term, which will increase the competition within this division and also suppress the margins of the company. And however, analysts are positive on this company overall, driven by its chemical segment. The analysts expect SRF to clock over 19% top line and bottom line growth in FY23. Coming to InfoEdge India, this internet services player saw beat analyst expectations on revenue by 10% in Q1 FY23. It also outperformed its industry in terms of revenue, driven by its core business, which is of recruitment solutions, which also houses the popular website Naukri.com. Yes, that's right. So, InfoEdge is currently trading at a lower valuation compared to its industry. However, its forward value PE valuation for FY23 is still very high at 84 times, considering the EPS consensus EPS estimates of analyst, and it's also much higher than the other internet services player, which is Just Dial. However, folks, Just Dial has seen its revenues and net profits fall ever since FY20, which can explain the lower valuation here. The the recruitment solution segment of the company saw its revenues grow at a compounded growth rate of 14% over the course of last 5 quarters. This is because of better hiring demand from the IT sector, which happens to be the flagship user segment for Naukri.com. The sector has seen higher attrition rates and a shortage of talent in the last 12 to 18 months, and this has clearly worked for Naukri.com, and you can see the share of IT services within its revenue pie has also grown year on year for 12 months ended June 2022. So it's a recruitment business. uh, so however, the demand from the IT sector has been strong, but it has reduced in the last 1 to 2 quarters. According to the company's management, the company saw robust demand from sectors like education, healthcare, travel, and hospitality in the in Q1 FY23. So the revenues for the recruitment solution segment jumped over 65% year on year in Q1 FY23, backed by healthy demand and better pricing as well. However, the InfoEdge India continues to clock losses in its businesses like 99 Acres, Jeevan Sathi, and Shiksha. They're basically companies seeing higher competition from other real estate sites like Magic Bricks, No Broker, Housing.com, which is forcing the company to spend more on marketing. The company has also not given any clear timeline as to when it expects to make profits in these segments. Yes, that's right. Folks, the growth trajectory of the recruitment business is also at a risk due to slowdown in demand from the IT sector. The US has been in a technical recession because it clocked negative GDP growth rate in the last 2 quarters, and the sentiment there is basically negative. And of course, according to the management, the management was also very unclear on the demand trends in the IT sector going forward. And in fact, it is also on a wait and watch mode. However, analysts are particularly positive on the company's core business and expect the company to clock over 35% revenue growth in FY23. There is a reason behind this because the Indian IT services companies saw all-time high attrition rates in Q1 FY23. According to TCS, the situation this is going to be the situation for a few more months before the attrition rates will finally decline. So this is definitely going to help boost the growth of InfoEdge India, at least in the near term. Moving on to IDFC First Bank. This banking player not only surpassed analyst expectations on net profit by a huge margin, but also outperformed its industry in terms of stock returns. The company generated stock returns of 35%, outperforming the banking industry returns by 30 percentage points in the last 1 month. The company is currently trading at a price to book of 1.4 times, which is half of the industry's value. The company saw its net interest income grow over 25% year on year in Q1 FY23, driven by expansion in the retail loans. Within retail loans, it was the housing loans, home loans, and consumer loans which outshined the other segments. Rural finance and auto loans also clocked decent growth in this quarter. However, and in fact, the company saw its its wholesale book decline 9% year on year, in line with its target to reduce the infrastructure book. And folks, we have to go a little bit back in time to understand why the company is doing so. IDFC First Bank was formed by the merger of IDFC Bank and Capital First. The merged entity inherited poor quality wholesale loan assets like that of Diwan Housing Finance, Reliance Capital, Cafe Coffee Day, and some other infrastructure loans as well. And in fact, the wholesale book was nearly half of its total advances back in December 2018, and infrastructure loans were also like 20% of its advances back then. And folks, infrastructure loans that the company had saw higher NPAs. There was delay in interest and principal repayments. The company also enjoyed lower margins in this segment owing to higher credit costs. Yes, that's right. And this is the reason that it focused on building high margin retail book, because its decisions on the wholesale side clearly went wrong. And it's another focus of its was to reduce the infrastructure book to zero within 5 years of the merger. Yes, that's right. Today, the retail book, occupies over two-thirds share in its loan book, and the infrastructure loans are just 6,500 crores, which are left on its book and which have high NPAs. And because of this improvement in loan mix, the company's net NPA ratio has also fallen steadily in the course of last 5 quarters. However, its net interest margins fell sequentially because there was a lag in passing the higher interest rates on to its consumers. Folks, this is a company which saw its loan book grow at a CAGR of only 6% in the last 3 years. However, the company bank now targets to grow its loan book at 20 to 25% CAGR in the longer term. This growth hinges on the expansion of retail loans, especially home loans. The company also looks to expand its return on asset to 2% from 1% currently. Yes, and analysts are also positive on this company in the near term and see its revenues growing 20% um, in FY23, and its net profit zooming 10x because of lower provisions and lower base of FY22. So, folks, that was my time, and I hope you must have gained some insights on the mid cap companies that we discussed in this video. Thank you so very much, and have a great day.